Real estate or ETFs? Which one would you rather invest into? It's a question that gets asked a lot, and for good reason. You'd have to agree with me that saying that I'm a real estate investor is much more sexier than saying I'm an ETF investor. There's just something about real estate that just appeals to everyone. Maybe because it's always been associated with the Australian dream to own your own house with a white picket fence and a large backyard. Or because of the numerous reality TV shows that revolve around real estate. I don't know about you guys, but I don't get that same visceral feeling when I talk about investing into ETFs. It sounds and feels, to be completely honest, boring. But that doesn't mean that investing into ETFs should be dismissed. Both real estate investing and ETF investing are both great investing strategies that we can use to grow our wealth. However, they are both very different investing strategies, and it's important that we understand what the differences are so that we can make the best financial decisions for ourselves. So that's exactly what we'll be covering in today's video. And at the end, I'll even go through a real life example so that you can see firsthand how the numbers actually stack up. So firstly, let's talk about all the pros about real estate investing and why so many people in Australia opt to invest in this asset class. Probably one of the biggest pros that comes with investing into real estate in Australia is negative gearing. Negative gearing occurs when the total cost of owning and maintaining your investment property, such as your mortgage, maintenance, and property management fees, exceed the rental income generated from the property. This results in a net loss, which can then be used to offset against your other sources of income, such as your salary, reducing your overall tax liability in the short term. For example, if you earned $100,000, but your property investment is negatively geared and you incurred a $10,000 tax loss, you can reduce your taxable income to $90,000. Thus lowering your overall tax bill. The goal of negative gearing is to actually profit off the property's appreciation in value over time, such that when you sell the property in the future, the capital gains that you actually receive from the property far exceed the capital losses that you've incurred thus far. The second reason why people love real estate investing is the ability to use leverage to maximize your return on investment and help you generate wealth quickly. Now, what is leverage, you might ask? It's basically using other people's money to finance your investments. For example, let's say you want to buy a property worth $100,000, but you don't have $100,000 in cash sitting around. Well, that's actually not a problem at all. As long as you had $20,000 available as a down payment, the remaining $80,000 can be financed through a mortgage. This is an example of using leverage to finance your investment. You're only using $20,000 of your own money to purchase a property worth $100,000. And as the property appreciates in value and you pay down your mortgage, your equity in the property will increase. Of course, we have to understand that leverage is like a double-edged sword that can work against you if the market swings against you. The last reason for property investing is that you have far greater control than ETFs. When it comes to ETF investing, you basically have no control on your returns, as you're at the mercy of the stock market. If the market is doing well, then your investment makes you money. However, if the market isn't so hot, then neither will your investments. But when it comes to property investing, if you buy and manage your property well, there are so many different ways to increase your return on investment through what we call sweat equity. Like literally by using your own sweat, you can increase the equity in your own home. You can increase the value of your property by doing renovations. And during times of low interest rate, you can refinance your property to increase your cash flow. All of these things are possible with an investment property, but just aren't possible when it comes to investing into ETFs. However, just like everything in life, it isn't all sunshine and rainbows when it comes to real estate investing. Next, let's talk about some of the major downsides of real estate investing that we have to be aware of. The first major downside is that real estate investing oftentimes requires large upfront cash to get started. Now, it's not in the millions, but it's definitely significantly more than what you need to get started with ETF investing. You could get started with ETFs with as little as $5. However, with real estate investing, at a minimum, you need to put down a 10% deposit, if not more. So if you wanted to buy a $500,000 property, you would need at least $50,000 in cash just for the down payment. And we're not even taking into account all the other costs associated with purchasing property, such as conveyancing fees, stamp duty, etc. The second downside to real estate investing is that your money isn't easily accessible. A fancy financial term for this is that it's not liquid. This is in contrast to investing into ETFs, where you can at any time sell your shares and then have money in your account in just a few days. With real estate, if you needed the money that you had invested into that property, then most likely you're going to need to sell the property to gain access to it, which could take months, and this is also highly dependent upon the real estate market at the time. In the meantime, you'd still have to pay for your mortgage repayments, any repairs that might come up, and all other costs associated to managing property. Which leads into the last major downside, is that oftentimes people underestimate just how expensive it is to maintain property. If you've got renters and they're causing damage to the property, or even just from normal wear and tear, broken plumbing, malfunctioning AC, or termite infestations, these are all issues that you'll need to spend money on repairing. Moreover, over the past few years, rental laws in Victoria have been passed that put renters in a much more favourable position than landlords. There are now minimum standards that landlords must ensure that property meets. Tenants can now keep pets in rental properties and have much more freedom to personalise their rental homes. These are just a few of the changes that have been passed over the past few years that have drastically increased the cost of maintaining property for Victorian landlords. Now, after weighing up the pros and cons of real estate investing, if you've come to the decision that real estate investing is right for you, then the best search to use to search for your next investment property is homes.com.au. They've built the next generation of property search for property investors leveraging AI. You can now search for properties and suburbs with the best historical capital growth in order to maximize your capital gains. Or how about optimizing your cash flow by searching for properties with the highest rental yields that will give you a positively cash flowing property? There's also more than 30,000 off-property markets not available to the general public, allowing you to get ahead of other property investors and have less competition when it comes to purchasing that next investment property. Typically, you need to work with a buyer's agent to gain access to these off-property market listings. And at the end of the day, they're going to be charging you tens of thousands of dollars for their service. But all of these features can be made available to you through homes.com.au through their Buyer's Edge subscription, which is just $12.95 per month with no lock-in period at all. And if you use my code Raymond when you sign up, you can receive an additional 20% off your subscription every month. Links will be down in the description. Now, when it comes to investing into ETFs, one of the main pros is that by nature, they are highly diversified and less risky. Diversification is the key to reducing your overall investment risk. The fastest way to get rich overnight is to buy the next Netflix, but the fastest way to lose all your money is to own the next blockbuster. To know which specific companies will do well is nearly impossible. However, you don't need to have a magic ball to get great returns on your investments. If you buy an ETF that tracks a large broad market index like the ASX 300, then your investment is highly diversified, and its performance will match that of the companies that the fund is indexing. Now, is it possible that you lose all your money through ETF investing? Of course, there's always that chance, but this also means that the top 300 largest companies in Australia have essentially gone bankrupt. And in that case, the value of your investment portfolio will be the least of your worries. Another reason why ETF investing is so effective are its low operating costs. Actively managed funds are known to charge anywhere between 1 to 2% in expenses. This means that between 1 to 2% of your total investment portfolio is deducted each year in fees. If you had a $100,000 portfolio, that's up to $2,000 each year that you'd have to pay in fees. And studies have actually found that more often than not, actively managed funds don't even beat the index. By contrast, ETFs are actually much cheaper, given no person is actually managing the fund's performance. There isn't a person deciding which stocks to buy or sell, or when to buy and sell them. The funds simply replicate an index, and as a result, most ETFs have an expense ratio well under 0.2%. So on that same $100,000 portfolio, you'd only be paying $200 in fees per year. Now, one of the major downsides of ETF investing that I touched upon before is that you're at the mercy of the market. With ETF investing, you're investing into the total market. You don't have control over which stocks or industries you want to invest in. If the overall market is down for the year, your portfolio will be down as well. For example, at the start of 2020, the overall stock market dropped by more than 30% in a matter of weeks, all driven by the fear of the coronavirus and the instability in the stock market. If you're invested into an ETF during that time period, then your portfolio probably took a pretty hard hit because it reflected the overall market. Another downside to ETF investing is that you'll always get the average returns of the market. Nothing more, nothing less. You don't have any way to increase your returns, and your overall investment returns are capped at what the market returns are. On average, over the past 20 years, the S&P 500 index has returned 11% per annum, the Nasdaq returned 14%, and the ASX 300 returned 10%. If you are invested into any one of these indexes via an ETF, these are the maximum returns that you would have received over that period of time. If you want above average returns, then you'll have to take on more risk. Alright, so enough about the high level pros and cons of real estate investing and ETF investing. Let's instead look at an example of if you had $100,000 to invest today and invested that into the share market versus into property, which one would yield you better results? So the data that I'll be basing all of my calculations from is actually based on 150 years worth of data backed by Westpac research. What the research shows us is that Australian property over the past 150 years has yielded 6.3% on average. Whereas when you compare this to the long-term historical trends of Australian shares, it's actually gone ahead and returned 9.8% annually, excluding any dividends. So just on paper, it seems like investing into the share market via an ETF is the obvious choice. So in the example with $100,000, we're going to be purchasing Australian shares and receive 9.8% return annually. But for the property, we're going to be purchasing $500,000 worth of real estate, growing at 6.8% per annum. And the reason being is that we can use leverage. The $100,000 would be enough for you to put down a deposit, as well as cover any upfront costs for a property worth $500,000. So in this example, the Australian shares will be growing at a higher percentage, but the initial capital investment with property is higher. And you'll actually see the impact of this straight away in year one. So in the first year, your shares will grow to $110,000, whilst the property will grow to $532,000. We can see how the power of leverage can really assist you in growing your wealth faster. After 5 years, our shares would have grown to $162,000, whilst our property would have increased in value to $684,000. After 10 years, our shares would be worth a little over $265,000, which is more than doubling our initial investment of $100,000. With the property, this is now worth $937,000. Now, although this isn't doubling the value of your initial property value, what we need to look at is the cash on cash return. So basically, how much money did I put in initially and how much return have I yielded on that initial money that I invested? So in this case, the shares are returning a 2.6x multiplier, whereas with the property, it's a 9.3x multiplier. However, we do need to consider that we have debt on this property. If we took out a mortgage at 90% leverage, then this means that we would have had a $450,000 mortgage. So it would go from $937,000 to more like $380,000 worth of equity, which means that our cash on cash return is around 3.8x after factoring in the debt that we took out initially, which would still be significantly higher than the shares in this example. If we continue to extrapolate this out over a longer time period, the difference in the cash on cash return between shares and property is just going to continue widening due to compound interest. In this example, hopefully I've illustrated the power of leverage and how real estate can really help you grow your wealth a lot faster. Now, at the end of the day, both of these asset classes are great investment vehicles that we can use to grow our wealth over time. Investing into shares can yield great results, and historically speaking, they have a higher return on investment. But investing into property will almost always require you to leverage yourself with debt, which means that your initial starting capital is going to be significantly higher, which results in your returns being magnified as well. Personally, I believe that both ETF investing and real estate investing can both play a part in our own wealth building journey, as they are both great asset classes to hold for the long term. And that's pretty much everything I had to cover off in today's video. If you've enjoyed the video or have learned something new, make sure to hit that like button down below and consider subscribing for more personal finance content in the future. And if you're interested in getting started into real estate and want to know how much property you can afford based on your own salary, then you might want to check out this video right here.